$7,300 billion. That's the figure almost no one talks about, yet it should be plastered across every headline. A colossal amount, larger than the GDP of many entire countries, now sits idle in U.S. money market funds. Welcome to Telnomics, the channel where we connect numbers to power and reveal how they shape geopolitics and the global economy. In today's video, you'll understand why this historic accumulation of cash is not a sign of safety, but of danger. Stay until the end, because what begins with staggering numbers could end with a revelation that might change the way you see the future of the economy. But what exactly is a money market fund? In simple terms, it's a type of investment that works like a supercharged savings account. It channels resources into short-term debt instruments considered safe. It sounds harmless, even prudent. But here's the catch. According to data from the Investment Company Institute, between 2023 and 2025 alone, these funds received more than $2 trillion additional dollars. For comparison, between 1981 and 2001, it took 2 full decades to accumulate that same amount. What once grew slowly and predictably has now turned into an almost vertical leap. And every time we've seen this surge before, the outcome wasn't prosperity. It was collapse. In the late 1990s, the buildup of idle cash preceded the dot-com bubble. Between 2006 and 2007, the same pattern emerged before the housing market implosion. In 2019, another wave of parked liquidity came just before the brutal freeze of the pandemic. Now, in 2025, we're facing the largest accumulation in history. What's coming next? Think about this. When trillions sit idle, they stop flowing into innovation, consumption, and production. It's like removing oxygen from a living organism. The economy suffocates slowly, while many deceive themselves into believing that keeping cash on hand means protection. But does it really? If this money doesn't circulate through the system, who finances small businesses, jobs, research, or construction? Who keeps the engines of growth running? What's striking is that even the world's biggest investors, including Warren Buffett, are paying close attention to this same trend. They're not chasing short-term highs. Instead, they're quietly stockpiling cash. But if the giants of finance aren't trusting the market, should you? This is only the beginning. Because the real question we need to answer is not, why is the money sitting idle, but what is being left behind? And that's exactly where the real investigation begins. Are you ready to uncover what the economy is choking on right now? The idea that hoarding cash equals safety is, in practice, a dangerous illusion. History shows this clearly and repeatedly. In every cycle, when cash piles up to record levels, it doesn't strengthen the system, it weakens it. After all, money that doesn't move doesn't create jobs, doesn't finance businesses, and doesn't turn the wheels of the real economy. In 2025, we are facing a sum greater than $7 trillion, the highest ever recorded since these funds were created. The irony is that while they look like a safe harbor, these massive reserves have already been red flags at critical moments in history. Think back to the late 1990s. Money began to accumulate quietly, and shortly after, the world watched the dot-com bubble explode. In 2006 and 2007, cash reserves once again surged unnoticed by most. Soon after, the housing collapse plunged the United States, and the world, into one of the worst crises of the modern era. More recently, in 2019, the spike in money market funds preceded the global economic paralysis triggered by the pandemic. 3 patterns, 3 brutal crashes. Now, with the largest accumulation in history, would it be wise to believe that this time the ending will be different? The problem is structural. When money stops financing the present, the entire future becomes compromised. Companies that could expand or innovate fail to get credit. Infrastructure projects stall. Jobs aren't created. It's as if the economy is being slowly suffocated. The charts, according to the Federal Reserve, paint an alarming picture. In just 2 years, over $2 trillion have been added to this mountain of cash, forming a near vertical line upward. It's a sight that attentive investors notice, but most choose to ignore. So why does the general public insist on seeing this movement as safety, when in reality it may be a warning? Perhaps because it's more comfortable to believe that saving shields you from crises. But the truth is different. Oversaving has already been the trigger for previous collapses. The question remains, are we about to replay the same story, only on an even more dangerous scale? And what if, instead of protecting, this mountain of cash becomes the very fuse of a new crisis? That's the unsettling question guiding us forward. Because the issue is not only why investors are afraid, but who is being forgotten in the process. And the answer, as we'll see next, may reveal the most vulnerable part of the economy, the small businesses that sustain real life. Now look beyond the headlines about record highs in the S&P 500 or trillion-dollar valuations of tech giants. These numbers create the illusion of a solid economy, but a glance behind the curtain tells a different story. The gears of daily life aren't powered solely by global corporations or Silicon Valley behemoths. They're driven by small and medium-sized enterprises, the ones that hire, build, innovate, and keep local communities alive. And it's precisely here that the red warning light flashes. Data from the Russell 2000 Index, which tracks smaller cap companies, exposes an uncomfortable truth. Since peaking in 2021, this group of firms has remained in decline, unable to regain momentum. Meanwhile, large tech companies push averages higher, masking the weakening of what truly matters, the economic foundation. According to a Bloomberg survey in 2025, while the market capitalization of giants has risen by over 20% since the start of the year, many small firms remain stagnant or shrinking. This means the gains you see splashed across newspaper covers are concentrated in a narrow group, while thousands of businesses that sustain daily life are struggling to survive. And why does this matter so much? Because it's precisely these smaller businesses that feel the impact of higher interest rates first. When the Federal Reserve raised rates from nearly 0 to over 5% since 2021, credit became more expensive. Large corporations can fund themselves with reserves or stock issuance. Smaller ones cannot. They cut hiring, delay projects, shorten shifts. The Conference Board, in a report published in July 2025, noted that hours worked in manufacturing had fallen to their lowest level in years, while factory orders and building permits also declined. These are the kinds of numbers that don't make it to optimistic headlines, but reveal where the economy is truly bleeding. And so the inevitable question arises: if the giants grow while the small shrink, what happens to the system's balance? Warren Buffett has always emphasized that real value lies in companies capable of delivering consistent results, not in inflated valuations. But right now, the contrast is brutal. While investors cheer the record highs of big tech, millions of workers tied to small firms face wage cuts, instability, and silent layoffs. The foundation of the economy is losing strength. If the gear that sustains real growth begins to fail, what happens to everything else? This question takes us to the next critical point: the gravity of interest rates, the invisible force pulling the entire system downward. Interest rates are the gravity of the economy. That's not just a metaphor. It's a definition Warren Buffett himself has used. Since 2021, benchmark rates have jumped from near 0 to over 5%, one of the fastest increases in recent history. And like gravity, the higher rates climb, the heavier all assets become. The effect is immediate. Consumers spend less, credit costs more, and companies delay investments. According to the Federal Reserve, this surge has already slashed demand for mortgages, increased corporate borrowing costs, and deeply reshaped how capital moves through the economy. The impact shows up clearly in the data. The Conference Board, for example, reported in July 2025 that its leading economic index, a basket of 10 indicators designed to forecast activity, fell to 98.7 points, down 2.7% in just this year. This index includes measures such as new manufacturing orders, hours worked, and building permits, essentially a thermometer of the system's energy. And that thermometer is cooling rapidly. Here lies the paradox. When idle cash and money market funds starts earning over 5% safely, what incentive remains to take risks? Why fund a startup, bet on innovation, or launch a business when returns look more predictable by simply sitting still? That's when capital escapes from the very areas that could generate growth. Financial markets keep riding waves of hype, artificial intelligence, stock buybacks, but the real economy feels the slow erosion. And it's not a one-off erosion. It's continuous, silent, but undeniable. Small firms can't refinance debt easily, can't pass rising costs to customers, and lack the muscle to endure prolonged shocks. Meanwhile, ordinary investors glance at the S&P 500 and believe everything is fine, without noticing that the foundation is cracking. The divergence between index euphoria and weakening fundamentals grows sharper every day. If interest rates are the force pulling everything downward, the next question is inevitable. What factor could accelerate this fall and turn slow erosion into sudden collapse? The answer lies in a variable no central bank can control: oil. Oil has always been the great wildcard of the global economy. Warren Buffett often says no one can predict the price of a barrel with precision, and history proves him right. Since the 1980s, every significant spike in U.S. unemployment was preceded by a surge in oil prices. And it's no coincidence. Oil is the invisible backbone of almost everything. It fuels trucks that carry food, ships that transport goods, powers factories, and hits consumers directly at the gas pump. It's a chain reaction that drags the entire economy. Just look at the numbers. The Federal Reserve Bank of St. Louis shows that, adjusted for inflation, oil has surpassed historic peaks at critical moments. The oil shocks of the 1970s, the 2008 financial collapse, and the 2022 spike when prices climbed above $120 a barrel during the war in Ukraine. Each time, global economies suffered deep blows, and U.S. inflation curves moved in lockstep with oil. The lesson? The link between energy and instability isn't chance. It's a pattern. What's surprising is that in 2025, oil prices remain relatively contained. That might seem like relief, but in reality, it's an even greater warning. Because in a world already weakened by high rates, it would only take a fresh oil shock, triggered by geopolitical conflict, supply cuts, or sudden demand, to push the entire system into collapse faster than most imagine. And remember, oil's impact doesn't take months to appear. It's immediate. Rising prices spike transport and production costs, squeeze corporate margins, and the first reaction is almost always layoffs. A simple energy shock turns into a social crisis. And despite the energy transition, with rising investments in solar and electric, structural dependence on oil remains. So the question arises, if oil prices climb aggressively again, as we've seen many times in history, what happens to an economy already weakened by high rates and shrinking businesses? The answer could be the missing spark that transforms slow erosion into inevitable collapse. In 2025, we are living through a dangerous contradiction. Oil appears stable, yet the economy is more fragile than ever. This false calm is deceptive. According to the International Energy Agency, global demand is expected to keep rising until at least 2029, driven by emerging countries that still rely heavily on fossil fuels. This means any disruption in supply, from tensions in the Middle East to strategic OPEC cuts, could reignite a rapid price escalation. And in an environment already marked by high interest rates and suffocating businesses, even a modest spike could prove devastating. It's important to note that this isn't just a theoretical risk. Research from the National Bureau of Economic Research shows that oil price shocks have long-lasting effects on U.S. labor markets, reducing jobs and wages in sectors tied directly to transport and logistics. What does that mean for the average household? It means higher prices at the pump, heavier grocery bills, and more expensive airfares. Families feel the impact before official economic reports even confirm the slowdown. This is the invisible danger. We don't need a global financial crisis for the system to stumble. A single energy variable out of control can ignite the flames. And precisely because oil is so unpredictable, it acts as the matchstick that can set fire to an already dry landscape. Warren Buffett, for decades, has kept strategic positions in energy, not to speculate, but to shield against this inevitable risk. Because he knows that when oil spikes, it doesn't just shake spreadsheets, it destabilizes entire nations. So if we already have interest rates suffocating the economy, small businesses losing breath, and consumers pulling back, what happens when you add a spark like oil to this volatile mix? The answer may be the crack that transforms silent fragility into irreversible crisis. But if the picture is this bleak, what options remain for ordinary investors and citizens watching all this unfold? That's the question that leads us to the next step: how to survive this new cycle without being swallowed by it. There's no longer any doubt. The damage is done. The era of cheap money is over, and with it, entire business models that depended on easy credit and near-zero rates have disappeared. What we're witnessing now is the market's natural selection. Companies with weak fundamentals, heavy debt, and hype-driven valuations will not survive. According to an S&P Global Ratings report published in August 2025, corporate bankruptcies in the United States have already surpassed 400 this year, the highest level since the 2009 crisis. This proves the adjustment isn't a distant forecast. It's a reality unfolding before our eyes. But the big question is, how can anyone navigate this turbulence without being dragged under? Warren Buffett has always repeated that cash is power, but only if used at the right time. This means accumulating liquidity makes sense, but not forever. The challenge is to maintain discipline, protect capital, and wait for the moment when real opportunities appear. That's where prepared investors stand out. They don't panic over headlines or temporary drops, but they also don't get fooled by short-lived rallies. The key lies in durability. Businesses with solid cash flow, low debt, and long-term management are the ones most likely to withstand cycles of crisis. This has been Buffett's guiding principle in every major market shift. And you, as an attentive observer, must ask yourself, are you chasing euphoria or building resilience? Are you reacting to today's news or planning for the next decade? The current scenario may feel suffocating, but there is a silver lining. History shows that every contraction cycle creates room for extraordinary opportunities. The investors who stay calm and observe closely are the ones who emerge stronger on the other side, but only if they understand that the greatest asset is not cash in the account, but perspective, because perspective shapes choices, and choices define destinies. If you've made it this far, you're already part of a group seeking to see beyond the headlines. That's why we invite you to subscribe to Telnomics, like this video, and share your thoughts in the comments. The conversation doesn't end here. Thank you for being with us. And remember, numbers change, cycles turn, but your vision can be the difference between merely surviving and truly thriving.